Welcome back to this tutorial series on algorithmic trading and investing with the Darwin API. And today we're going to take a slight tangent, a very interesting and exciting one, to our usual norm of implementing API endpoints, functionality, and demonstrating use cases to do with the same. Today we're embarking on a sub-series within this series on Quant R&D and algorithmic trading strategy R&D. And we're going to outline with this introduction the exact process that quants would follow as regards a data source. In this case, our data source is the Darwin API. And we're going to go about describing the exact workflow that at its bare minimum needs to be followed in order to implement a quant workflow, in this case using the Darwin API. And to do so, we've crafted an entire example trading strategy involving every single component from theory as well as implementation in Python 3 using the Darwin API. So this is going to be a long tutorial. It's going to cover a lot of material. It's going to cover a lot of financial concepts as well as programming concepts. So it's a crash course in repeating everything we've discussed so far in Darwin API usage, but also in terms of quant finance, what is required in order to embark on a quant R&D related journey. So follow along. And if you haven't seen the Darwin API videos prior to this tutorial, we strongly encourage that you do, as it will give you a richer context coming into this tutorial and future tutorials in this series. So to demonstrate everything, we've crafted this Jupyter Notebook, and it references content, Darwin API functionality, and example source code that's been covered in past video tutorials. We've developed some live, we've provided some on GitHub, and all of that is accessible through both the video playlist as well as our Darwin API GitHub repository called Darwin API Tutorials. So as regards this introduction to trading strategy R&D, we'll be focusing on a workflow that involves developing a hypothesis, assessing the data requirements for our hypothesis, then creating the data set based on the data we need, generating factors that our hypothesis relies on in order for us to then go ahead and craft the strategy, calculate returns, and evaluate accordingly. We also need to conduct some statistical tests on our outputs that we won't be covering in this tutorial, but they will form a good chunk of future tutorials as they come in. So today we'll be following the first 6 components of our table of contents here, all the way from developing a hypothesis through to evaluating the results of our hypothesis. Now, developing a hypothesis is a very broad area, and it is full of several different angles. So you can develop hypotheses based on backtesting, data mining, domain knowledge, ideas gathered from external sources, from colleagues, etc. There are several different ways to develop a hypothesis, or you could obviously develop a hypothesis based on observation of markets. For today's tutorial, what we're going to do is assume knowledge of a momentum factor and go ahead and try and implement this momentum factor. And along the way, I'll describe how we're going about doing so. The momentum factor will essentially consider returns from previous periods as possibly predictive of future returns on the same Darwin portfolio. We'll also be constructing Darwin portfolios of different sizes and going about constructing logic for how to go ahead and do that. What this tutorial will not be covering is performance fees. These are very, very important to consider in calculating your final returns. We do not have the time for this video to cover them in detail, as it is a fairly lengthy implementation and needs to be discussed in isolation. So we'll cover that in a future tutorial dedicated to performance fees and transaction costs. This tutorial also does not consider volatility of returns and doesn't cater to data using the volatility of the returns time series that's being used. It also doesn't cover divergence as a cost at this point in time. It has a fixed transaction cost that we'll be implementing shortly. No customization of portfolio weights, therefore no portfolio optimization is conducted in this tutorial. And also, as you're aware, Darwin validation dates are extremely important to consider when constructing portfolios, the validation date being the date that the Darwin actually started trading at Darwinex. Any past data came from the Darwin provider's previous brokerage. Now, that is not to say that the previous brokerage is not reliable. It's just to say that data after validation is most certainly reliable, as it has been generated and executed in the Darwinex environment. Now, in terms of the hypothesis, the momentum factor we were talking about earlier on, we're going to go ahead and create a dummy hypothesis. This will fail because no thought has been put into it whatsoever. The idea behind this tutorial today is to show you how to go about quant R&D using the Darwin API, accessing the various different parts of the Darwin API, and using your domain knowledge about Darwins in the context of strategy development. So this hypothesis will basically assume that a Darwin's end of day return or end of week return or end of month return, the 3 periods that we'll be testing in this trading strategy today, the Darwin's end of period return is possibly predictive of the direction of its next period return. To keep things simple, what we'll do here is that we won't look at anything other than return, and we'll only trade the top X Darwins by end of day, end of week, or end of month return. This text needs updating here. It will be prior to being uploaded to GitHub, but essentially we will be looking at periodic returns, not just end of day returns. Now, this momentum factor will require some data. What that data is, it will be composed of, obviously, Darwin assets. So we'll need to construct a universe of assets. We'll need quotes for each asset. These will enable us to calculate returns. The factors we'll need for this particular trading strategy, this dummy hypothesis that involves this momentum factor that's considering end of period returns as predictive of future period returns, we're going to need to construct past returns and future returns time series. So those are the 2 sub-factors that we'll construct using quotes acquired from the Darwin API. We'll also then calculate projected returns of a long-only Darwin portfolio based on all of the above. In order to do so, if you've been following along the Darwin API videos recently, you'll know that we'll need to use the Darwin Info API that allows us to get both symbols and quotes for our Darwins of interest. In this case, we want to construct a universe of all available Darwins that have status active and deleted. And deleted is important because we can't just take active Darwins, as that will essentially allow us to mitigate any Darwins that failed along the way and hence introduce bias into our backtesting. So we have to call the API for both active and deleted Darwin symbols and then download the histories for those accordingly. Given that that will take a significant amount of time, we've already done that for you prior to recording this tutorial. So we have a file that has downloaded all this data for Darwins that are of active and deleted status or deleted status up until the 12th of June 2019. And this data is located for you in a pickle archive inside the data directory on GitHub, where this Python notebook resides as well. Now, you must observe, when doing this yourself, you'll need to observe API limits. So make sure you've consulted the API documentation for the most recent, most up-to-date API limits, as those can affect how your download goes and any breakages that you may need to deal with if you've exhausted your API consumption limits for the period in question. And that's essentially it. And once we have the data, just to recap really quickly, our hypothesis is that we're generating a momentum factor that targets that looks at end of period returns as possibly predictive of future period returns, the direction of future period returns. It then calculates various periods over these returns using past and future returns that we need to calculate using quote data from our Darwin universe. It then calculates projected returns for a long-only Darwin portfolio and goes ahead and processes it. For this, we've written code to accomplish this. The code here loads the data from the pickle archive that I mentioned recently. When implementing this via API, you would substitute your code here with Darwin Info API specific code. Specifically, the function you would need is get historical quotes that it has been covered in previous tutorials in the Darwin API series. We also construct a graphic helpers object, as we'll be plotting a lot of things. And since this is a Jupyter Notebook, we'll be setting init notebook mode to true for any plotly functionality that we intend on using heavily towards the rest of this tutorial. Also, we are going to, for this tutorial, exclude any data that has a day of week value of less than 5. Essentially, we will keep only data that's Monday to Friday and exclude anything else. We will also load, for evaluation purposes later, a series of FX market volatility data, and I'll explain why we're going to use this for evaluation later, as since we're generating a momentum factor from domain knowledge, we can also hypothesize that momentum is most likely correlated to movement of the market in some way. Hence, Correlation to volatility is something that may affect our returns, and that is something we're going to both try and observe and then evaluate numerically as to the validity of that theory, that statement. Then we go ahead and plot a few things to do with our data set, just so we know how many Darwins there are, what symbols they have. And we're going to use a test Darwin to do some plotting. Obviously, plotting 5,331 Darwins on a single chart would be fairly cumbersome in terms of the space it would all take. It wouldn't look very intuitive and be difficult to navigate. So for any implementations here that involve plotting a series for demonstration purposes, we've chosen a test Darwin, LVS 4.20 being the ticker of this Darwin, and we're going to plot it along the way to demonstrate not only the plotting functionality that you can use that is available to you in the TWX Graphics Helpers class on GitHub, but also to demonstrate what this looks like when using Plotly in notebook mode. So here we are with our first plot, where we've very simply plotted the quote series obtained via the API and loaded from the pickle archive into our environment. And then done a tail on the data frame to show the last 5 quotes that are present in this particular data set. In terms of returns, the remainder of this notebook will use logarithmic returns, but feel free to use simple returns. Now, the differences between simple and logarithmic, the benefits of using logarithmic over simple returns for backtests that involve a large number of assets and possibly with very long track records. So if you have a very large data set, there are some advantages to algorithmic traders of using log returns over simple returns, and they relate to certain properties of log returns that are beneficial towards a backtesting exercise. For example, log returns are time additive. That means to continuously compound them, you can sum continuously compounded log returns as opposed to do multiplication, compound multiplication on compounded simple gross returns. And this affords us a bit of efficiency in terms of time and the order 1 versus order n complexity of performing the calculation on large data sets. There's also something that's mitigated by logarithmic returns, and that's arithmetic underflow. And that's a scenario where sometimes the returns can be so small that the number is impossible to represent in computer memory. And that can cause errors that need to be addressed in writing the code. This is not something that requires the use of log returns to fix, but it is something that is automatically fixed by using log returns. So there are some advantages to using log returns that I've explained here. To calculate simple returns, it's very simply the current quote minus the previous quote divided by the previous quote, or which simplifies to current quote divided by previous quote minus 1. In the case of log returns, you would take the log of the current quote, subtract the log of the previous quote, and that would give you the log return. To implement this, we've created 2 functions for you, one of which we'll be using throughout the rest of this tutorial. That is calculate log returns. That essentially takes the data frame of quotes and subtracts it takes the log of the data frame of quotes, where quotes is a data frame containing columns as Darwin symbols, and the index being the dates over which the quote data exists. We'll take the quotes data frame, subtract the shifted quotes data frame. From that, shift of 1 will push the data down 1, allowing us to calculate returns. And for simple returns, we'll simply use pandas PCT change to calculate those returns. These functions are provided here for your convenience. However, from this point forwards, we will be using calculate log returns. In order to calculate log returns using these functions, we simply store our log returns, calculate log returns quotes into log returns and simple returns. Even though we haven't used simple returns down the line, this is just an implementation that shows you how all of this works. We then plot a few metrics for ourselves. This is all part of the workflow, exploring your data set, making sure it makes sense, printing things along the way that are of interest to you, that you would likely be referring to later. It's important that at this stage, when we haven't done any simulation, any backtesting whatsoever, it's important to just take a quick look at your data structures, at your data set, to make sure it makes sense and that all the numbers that you expect to see have been calculated correctly. And that's what we've done over here. We've printed out a few statistics. We've printed out a few pieces of our data frames in terms of returns, and calculated some price-based, log-based, compounded, and compound simple returns for the test Darwin in question, which is LVS 4.20. For our hypothesis, the momentum factor, where we're saying that periodic momentum returns, in this example, periodic past returns are indicative of future direction in future periodic returns, it's important for us to generate two additional series from our quotes data that is both past and future returns. Now, to select which Darwins to buy at the beginning of a new period, let's say that's daily, weekly, or monthly, we'll need to look at the past returns of all Darwins in the data frame. We'll then need to rank them in descending order of their most recent end of period return. End of day here is an example. We're covering 3 periods today: daily, weekly, and monthly. And finally, we'll select the top X number of Darwins in this ranked list. For our simulation, we'll be conducting tests between 10 and 50 Darwins in steps of 5. So we'll conduct a simulation where it goes from 10, 15, 20, so on and so forth, up until 50. And generating past and future returns can be achieved by using the .shift function in pandas, as we showed you earlier. And it's very simply log returns .shift1, where 1 represents the periods to shift. If the number is positive, it means that you're looking for past data. It shifts it backwards. And if you specify a negative number, it shifts it forwards. We will be needing the negative number to shift series forwards because we'll also need to calculate future returns in order to compare going forward. We've put all of this into a function for you where there's a function shifted return that returns that essentially shifts it for you. So in order for you to avoid writing a longer construct here, we've drafted a function for you here that allows you to simply supply log returns and the periods of interest as arguments to this function. We've also written the get top end Darwins by past return function for you. This accepts your log returns and the number of Darwins that you'd like to trade in this exercise. What you get as an output is a data frame of zeros and ones, where 1 is a Darwin that needs to be bought on the next periods open: day, week, or month. An important thing to consider here, particularly, is that if when going through the series of data, remember that the entire universe of Darwins, 5,331 Darwins in this data set as it may be, all of these Darwins did not exist at all points in time. Since we have a minimum stipulation that we're going to trade X number of Darwins at bare minimum, the top X need to be requested. There will be points in time where those top X are not available. It could be top 5, top 6, because that's the only number of Darwins available who had active returns at that point in time. To get past that limitation, we've introduced a restriction where we've said for this dummy exercise that if the number of Darwins retrieved is less than our top X value, in which in this case right now, for example, is 20 in the arguments list, then do not trade on that day. If, however, the number of Darwins retrieved are equal to the number of Darwins we requested, then set those particular Darwins to 1. And top underscore end holds the indices for those Darwins that need to be set to 1 in this data frame. The output data frame will then contain zeros and ones, where 1 will be the Darwin that needs to be bought, and everything else in the list that did not satisfy the criteria will be set to 0, thereby allowing you to easily calculate future returns going forward. We can use the same functions as we showed you earlier for shifted returns to calculate past and future returns. Very simply pass 1 to shifted returns in order to calculate past returns, and -1 to calculate future returns. We concatenate all of these together and display them to show you how log return looks against past return and future return. Further down in this series, here's an important part, possibly the most important part of this section in this tutorial, is the way the data is presented. And it's important to make sure that our intuition is clear on how the data is presented here. For example, on the 11th of June, 2019, the most recent past return, you see in the past return column, is to use in calculating the day's projected returns later on. This past return is negative 0.012200, or minus 1.22%. Well, the future return over here is not a number. It's not available. And it's important to note that this is precisely the behavior we expect, since we only want information that's valid up to this day. Remember, when trading on the 11th of June, this quote, being a close quote, does not exist at the beginning of 11th of June that we're starting this exercise. So because we don't have this data available to us, at the beginning of this day, we will only have the past return of negative 0.0122 available to us. And that's what we will be using in order to make the execution if there's a valid case to make the execution. In this case, because we're using a momentum factor and ranking by the largest past X number of returns, a negative value won't result in an execution. If we don't do this, we'd be peeking into the future, and naturally that would generate a fantastic backtest. So if you'd like to engineer something that looks very nice, then shifting this data one step forward will allow you to generate a very good backtest, and that's not something we recommend. Right, so at the end of the day, which Darwins need to be traded tomorrow, or tomorrow this being, or in the next period. So on the next day, week, or month. And the way to do that is very simply to sort in descending order and extract the top X that you require in order to do so at any one period in time. That generates the list of Darwins that you need to trade in the next period. This will be covered by our get top end Darwins function that we wrote earlier on, and this will automatically be done for you so that you can focus on doing the necessary calculations later as regards strategy returns. We've also done a little example here of which Darwins have been traded most historically, and to do that, we've essentially taken our top-end Darwin's data frame that lists 1 for all Darwins that need to be traded and 0 for those that don't, and has taken the sum of those, sorted it in descending order, and from that has extracted the largest 20 values in this case, representing the top 20 most traded Darwins historically in this dummy hypothesis. The next phase of our quant workflow is calculating the strategy returns. And now that we have a data frame containing the number of Darwins that we'd like to trade every period, and a data frame containing the future returns, we can calculate the strategy's returns by simply multiplying each corresponding row in both the top-end Darwin's data frame and the future returns data frame. And for that, we've created a function for you here called calculate strategy returns that accepts the data frame of 1s and 0s that represent the Darwins that you'd like to trade and the Darwins that you'd like to avoid trading. It also includes the future returns data frame that you calculated earlier using the shifted returns function. And finally, it also takes the number of Darwins that you'd like to trade. In this case, this is the minimum number of Darwins that you'd like to trade. And it also takes a cost parameter that allows you to subtract a transaction cost from your future returns as well. This is important to note. Every Darwin on purchase, especially if it's active, will incur some form of deviation from the purchase price the purchase quote that you've requested and the purchase quote that you've actually received. On average, this will be about 0.1% being very, very, very conservative. In this case, it'll be anywhere from 0.07 to 0.1% per side. So by taking a very conservative estimate of 0.2% transaction cost in this case, we're able to be slightly more pessimistic and try to break our strategy. And by using a value like this, you're automatically going to err on the side of caution. Hence the 0.2% round trip cost associated with each trade. Each trade meaning opening the execution and closing the execution in the period. To calculate the strategy returns, you take the top Darwin's data frame of 1s and 0s, multiply it by the future returns minus the cost per transaction, and normalized by the number of Darwins that you have requested. In this particular case, we are assuming equality in weight. So each Darwin will receive an equal allocation in this particular strategy to keep things simple. We're not going into any portfolio weights customization at this point in time. Finally, since we've discussed everything, all the bare bones of this entire dummy trading strategy, we now know how to calculate the factors, the past returns and the future returns. We've written functions for each of them. Our workflow has so far led us to a point where we now have all the components necessary to go ahead and craft the actual strategy. So we can now encapsulate all of this into one main function that accepts the time frame over which you'd like to conduct the analysis, the number of Darwins that you'd like in that analysis, and the transaction cost parameter that you'd like to be subtracted from future returns prior to you generating the strategy returns. And for this, we very simply, once again, we load all the quotes from our offline file, which is a pickle archive, so that we can save time on polling the actual API for this information. We make sure that we have only business days, trading days in our data set. And we make some adjustments in case we've selected a weekly time frame, making sure that our weeks end on Fridays, and we've taken the last value received in that week window. Same for month, so on and so forth. We calculate our log returns, our past returns, and our future returns. These three represent our factor data. So we have our log returns, which are the actual returns of the quotes, and our past and future returns factors that we will need to make the assessment of projected returns. We then calculate our top-end Darwin's data frame in this of ones and zeros that sets everything to zero that isn't going to be traded and sets everything else to ones. We then calculate our strategy returns using the formulation over here in this function. And finally, we have our strategy returns. Then we calculate our cumulative returns. Remember, these are log returns, so we can do a sum as opposed to a cumprod in Python or a cumulative product. And finally, we have, if our cumulative strategy returns go below -1, then we set everything to -1, since it's impossible to go below 100% negative equity and still have money to trade. And finally, we return our strategy returns and our cumulative strategy returns in a list object back to the calling function. There's a reason behind this that we'll explore shortly. Now that we have our strategy drafted, we need to come up with a parameter range over which to test this. And for this dummy simulation, what we've done to show you how to go about robustly testing a parameter space, and not only doing so for testing it robustly, but also to make sure that you aren't necessarily overfitting to any one particular parameter space and biasing the outcome of a strategy that could otherwise have performed completely differently. In order for us to do so, we've selected a range of between 10 and 50 Darwins in steps of 5, setting transaction costs to 0.2% round trip. We've then written a plot strategy results function that serves two purposes. It returns raw results and also plots them using the plotly data frame scatter function that has already been provided to you on GitHub in DWX graphics helpers. We loop through our range of Darwins. And for each test, we store the results in a dictionary object that is keyed by the test we're conducting. We then transform these into keys and values for us to be able to construct a data frame to plot. And once that's achieved, we go ahead and start conducting tests on each of the periods and number of Darwins that we are interested in. This function is available to you in this notebook. Though I'm looking at an HTML version of the notebook right now, you have both the HTML version as well as the Jupyter Notebook itself available to you on GitHub in the Darwin API Tutorials repository. The first test conducted with daily sampling with a transaction cost of 0.2% in steps of 5 top-end Darwins. And as you can see from the results, it is very quick to fail and be discarded from our list of things to consider in terms of this dummy trading strategy. We go from 10, 15, all the way through to 50. The results are very quick to fall to -100% equity, leading us to conclude that the momentum factor on a daily basis is most definitely not predictive of future daily returns in this data set. The next test we conduct is, since daily failed, and we may possibly be looking at way too noisy a factor set for that sort of simulation, let's resample the data to weekly and retest to see if there's any improvement. If daily is too sensitive, and weekly may yield possibly better results. We go ahead and do the same thing with the plot strategy results function that we've written so that you can achieve this sort of testing very easily. And this is all to give you an example of how to go about constructing code for yourself to enable you to test fast and do it in a way that makes it flexible for you to test various scenarios as we are right now. In our weekly test, again, we pass the same range of 10 to 50 Darwins in steps of 5 with a transaction cost of 0.2%. And we calculate with a weekly resample. The results now are slightly better, but this strategy is nowhere near investable because we're still on aggregate losing. And obviously that doesn't yield itself to any future testing to possibly see if there's any alpha in this data set at this point in time. But as an exercise, it has allowed us to conclude that even though the weekly momentum factor is losing, it definitely demonstrates more strength than the daily momentum factor that was losing straight away and not yielding any alpha at all. Finally, we conduct one more test with the same parameter range of 10 to 50 Darwins in steps of 5 with a transaction cost of 0.2% on a monthly resample data. And this time we get a slightly different result. This time we have what appears to be possibly an alpha source. And we may have ourselves an alpha factor in the form of a monthly momentum factor. But can you spot something that is not right in this factor, in this result set? And what's not right in this result set? Before I continue anything about that, I encourage you to, if you have an idea as regards what you're looking at, please do share it in the comment section of this video right now so we can see it and so other people can contribute as well. And what's immediately visible is that there are some things that make sense. For instance, as we increase the number of Darwins, the blue line being the number of Darwins being 10, and as we increase the number of Darwins, it makes sense that the cumulative return over time decreases as we introduce more and more assets into the picture. And also, there is a hidden benefit here of diversification that we're introducing into the picture as well. Obviously, we haven't looked at anything to do with correlation in this analysis, correlation between assets, but it suffices to say that a portfolio with 50 Darwins is unlikely heavily correlated, is unlikely full of assets heavily correlated to each other, as opposed to one that has fewer assets. So in that respect, the results make sense. But what is interesting to see is that as of the February to March period, suddenly all our series go into a complete shift in trend. And this is something that yields a strategy where we're going to be suspicious of the outcome, because if everything has been great up until this point in time, but suddenly we've had a complete breakage of this momentum factor that demonstrated excellent behavior, then we have two things to consider. We may possibly, without overfitting anything, have hypothesized a factor that is inherently overfit. The likelihood of that is 50-50. The other thing that, from a quant's perspective, that you need to look at is, well, if this factor did exist and was indeed an alpha factor up until this point in time, what happened in the February to March period that resulted in this factor declining in performance over time? And that's something that we're going to address with our volatility data that I talked to you about earlier, that we preloaded for you and have provided to you on GitHub for you to use as well. This is FX market volatility data that's been generated using a proprietary technique we use in Darwinex Labs, and it will allow us to essentially validate our hypothesis a little further. If you remember from earlier on in this conversation, we hypothesized that momentum is likely dependent or related in some way to volatility in the market, as momentum-driven returns are a result of good movements generally. So in order for us to make sense of the outcome of this monthly periodic backtest here, we're going to go ahead and load the volatility data that we've, as I mentioned, provided to you on GitHub as well. We're going to write some code, which has already been written for you and shared on GitHub, to generate a comparable data set whereby we can take strategy returns and compare them to the volatility data that we provided you to see if there's any correlation between different periodic returns and market volatility. For that, we've written three functions. One to generate the comparable data set, so you can go ahead and calculate the correlation coefficients. Another to compare the strategy returns to the market volatility, where you can supply the strategy returns and the volatility. That then goes ahead, creates the comparable data set, and plots the results for you. And finally, for all the tests that we conducted earlier and stored inside our dictionary object called results, we will then write a little function here that will plot all correlations to market volatility of all these tests. This code has already been written for you. To visualize all of this, you essentially execute each of the datasets inside your results dictionary for daily, weekly, and monthly for the periods in question, daily being an empty space, weekly being W, and monthly being M. And this plots the correlations for you of each of those tests. The x-axis of this series is indicative of the number of Darwins in our test. So 0 represents 10, 1 represents 15, so on and so forth. The index should really be changed to multiples of 5, but that's what the x-axis represents. In the case of the daily tests, it's observed that there isn't much in the way of positive correlation between returns and FX market volatility on the daily time frame. When producing this for the weekly time frame, it's observed that the range again is between negative 0.06 and 0.02. And even though as we increase the number of Darwins, the correlation to FX market volatility increases, the increase isn't enough for us to to sustain the theory that there is indeed, on the weekly time frame, a definitive correlation between asset returns generated through a momentum factor and FX market volatility. However, when we run the same analysis using the monthly tests, comparing them to FX market volatility, there is indeed a decent positive correlation between the results of the monthly periodic tests and the FX market volatility. And this generally shows an uptrend as we increase the number of assets in this momentum portfolio. So what this allows us to see is that even though there isn't a very strong correlation, the fact that we have between 0.18 and 0.22 is the mean of our mean sort of region of correlation, this is definitive in that there is certainly correlation between our monthly periodic strategy returns from this momentum factor and FX market volatility. If we go ahead and plot these, we can see these in a clearer light. So here, for example, we have daily returns, the daily test plotted against FX market volatility. Then we have the weekly test plotted against FX market volatility. In both these cases, the correlations aren't enough for us to justify a conclusion that, yes, there is definitely a correlation here for us to give some thought to. But finally, when we do run it across the monthly momentum factor, there is indeed a decent correlation that allows us to see that, yes, there is a relationship between the movement of this momentum-driven monthly strategy and FX market volatility. And what does that imply? What does that explain about the data that we have? The only conclusion we can draw in this basic trading strategy that we've come up with a completely randomly chosen momentum factor is that if there is a correlation between the returns and looking at the market volatility from that period of January, February, March 2018 downwards, we can see that as volatility has declined, and generally throughout the history of this monthly momentum factor, as volatility has exhibited decline, so have the returns of this monthly momentum factor over time. So in conclusion, what we've done today is taken a hypothesis. We've essentially outlined the quant workflow as applied to using the Darwin API, developing a hypothesis, assessing the data requirements, where to get that data from the Darwin Info API, then creating the dataset itself, involving the assets as well as the quotes from that dataset, then to constructing the factors required for validating our hypothesis. In this particular case, we chose a momentum factor that our hypothesis stated that we would like to see if there is predictive ability in past returns for a period on future returns of the same period. We then calculated the strategy returns using the factors that we hypothesized here. We calculated the factors. We wrote a lot of code to help us generate results from those factors. We also plotted various statistics as well as charts to enable us to visualize how our performance was. We conducted robustly a series of tests across a variation of minimum number of Darwins in our daily portfolio. We also included a very conservative transaction cost in order for us to attempt to break this strategy in case it proved to be profitable. In the first 2 periods of daily and weekly, we received little to no benefit, and both strategies lost very, very quickly, leading us to not doing any further analysis on them. In the case of the monthly, when we did see some potential alpha, there were some disturbing aspects of this result set, and these were there is a reliance on there is a possible relationship between this factor and market volatility, which we hypothesized through our domain knowledge, but which we also proved by comparing the results of our monthly momentum factor to market volatility and noticing a decent correlation between the two. What does that imply from a strategy developer's perspective? If we have something like this, where our strategy is vulnerable to a factor in the market, such as market volatility, then we may need to design a strategy that is able to stop trading in such situations, or to be a multifaceted trading strategy whereby we can have several components within one trading strategy outdoing the others' underperformance over time. And we'll get to this in future tutorials. So hopefully you've enjoyed what we've covered today. This is essentially a quant's workflow, a quant's approach to generating a trading strategy, all the way from hypothesizing what to look for to going ahead and accessing the Darwin API to assess the data requirements, create the data set, generate the necessary factors and returns, and to evaluate the results. This is a bare bones workflow. There's a lot that will be added to this in future tutorials, but if you've enjoyed this tutorial, then future tutorials will be containing a lot more depth, and we'll cover things such as generating performance fee time series, applying them over custom periods such as quarters from date of inception or date of first trade, so on and so forth. We'll be covering techniques such as portfolio optimization, machine learning to do with alpha research, as well as portfolio optimization and risk management, and so on and so forth. So hopefully you've enjoyed this, and see you in the next tutorial. As always, if you enjoyed this presentation, please do consider sharing it with your social networks, colleagues, co-workers, and friends. And do subscribe to the Darwinex YouTube channel so you remain up to date with all future videos that will be released in this series and other topics discussed on Darwinex. Thank you very much for your attention. See you next time.